So let's get across the drivers of this stock market slump and then where it might go to next with Perpetual's Head of Investment Strategy, Matt Sherwood. Matt, thank you for your time. First up, this fall, was early on especially much bigger than the US and Asia, Europe, I know. And I just wondered whether this might have been public holiday and a bit of catch-up, as Ed said, or whether economically we're in for something a bit tougher into the future?
Well, it's probably a combination of both, Ross. There's no doubt we had to catch up with what happened on Wall Street on Monday, but also Friday. But, futures markets are pricing at a lot of rate hikes here in Australia. So just in the last 3 weeks, they put almost 1.5% extra rate hikes. So that's something the highly indebted Australian economy and highly cyclical Australian economy would react very poorly to. So as a result, I think it's probably a combination of both those factors.
And we can't underestimate the fact that though Australia right now economically is in fantastic shape, the reality is that if you look forward, we are so sensitive to rises in interest rates in this country because of the government debt and also because of the household debt that many interest rate rises are really going to knock the stuffing out of this economy.
Yeah, it hits the Australian economy in two ways. First of all, it hits the household balance sheets, and quite significantly. And the second way, of course, is that housing is a big part of the Australian economy, and a much bigger part than what it is, for example, of the US economy.
OK, so just explain to me this chart that we can see now, movement in cash rates factored in by futures markets. And what this is really all about is that while economists say, well, the central banks can't raise by so much, they'll kill off the economies, the markets, the money markets are actually saying, no, there's big rate rises coming, and that's going to have a big impact on the outcome of stock markets and housing markets as well.
Yeah, absolutely. And so this is really what's happened post the May US CPI report, which just really dashed hopes that we are past the inflation peak. And what's happened in that chart is that just in the last 3 weeks, it's factored in 1.25% more rate hikes by the Fed, 1.4% by the RBA. And of course, the the Australian economy is much more sensitive because our mortgages a standard variable on the whole.
So let's go with this, because most economists say that the RBA will finish rate hikes at 2.25% to 2.5%. Where do the money markets say they're going to finish up?
They're going to finish at 4%, according to the money markets. And the economists are saying that because they can believe that, we can still get the soft landing because we don't quite have the inflation problem that the US does. And that is certainly
not at the moment, but we seem to be almost 6 months behind in a lag as compared. But all of the things that are going up in the US are the things going up here in Australia as well.
I mean, they're all global things.
It's gas, it's used cars, it's food now. It's all these things are the same things.
That's right. And economists pay attention to core, but that doesn't matter for households because food and energy matters a lot to households. It's a big part of budgets.
So if the Reserve Bank were to raise interest rates, the official cash rate to 4%, remembering it was 0.1%, what would that do to Australia's economy?
Well, I think we'd probably be back in recession territory if it got that high, just by the nature of household balance sheet, how big the housing sector is, overall, I just don't think the Australian economy could cope with interest rates that high.
OK, so what you're saying is that what we saw on the stock market today, that violent reaction we saw on the stock market today, is a direct relationship to those money market interest rates and those forecasts of how high the Reserve Bank, the Federal Reserve, might have to raise interest rates.
Yeah, that's definitely part of it, and we're going to have a good reporting season. There's no doubt of it in August because companies have been putting up their profits. The economy's been fine. And so, I think the August reporting season's actually going to be pretty good.
Well, see, that's the irony of this. All of a sudden, the profits are going to be very strong, but it's the future. It's this earnings per share growth in the future that's really dropping rapidly right now.
That's right. And what our model shows, you can see it's got a very good relationship with the actual earnings. So it's actually a very good forecasting model. So earnings growth globally peaked at 51% last year. The model's telling us, but at the end of this year, it's going to be minus 4%. But the big thing is going into next year, that's when the rate increases actually start to hit the economy. It starts to hit corporate performance. In the meantime, margins are going to be under significant pressure. So it all seems to be downside risk from here because the Fed is tightening into a cooling economy.
And we can never forget that the stock market is a reflection of what people think the economy is going to be like in 12 to 18 months' time.
Yeah, absolutely. Markets are always forward-looking. They're looking into, what's happening now. higher rate hikes than what we got in the last cycle, earnings growth coming off pretty significantly. And the big thing is the fact that we have quantitative tightening working in the background, which isn't really visible to many investors, but it's got a massive effect.
Matt Sherwood from Perpetual, always good to have you in the program. Many thanks for your time today.
Thanks for having me, Ross.